Now, the currency market in India is bracing for a tectonic shift. In a bid to arrest the volatility in the Indian rupee, the Reserve Bank of India, it announced curbs on currency derivatives trading. But what exactly is currency derivatives and how will this rule impact traders? Details in our next report.
The Indian rupee's recent instability made the Reserve Bank of India to take action by restricting currency derivatives trading. The deadline for the rule coming into force was set as April 5. However, the RBI has now delayed the rule's implementation to May 3 because of the extreme moves and volatility in the rupee. What does currency derivatives mean? Currency derivatives are contracts that deal with buying and selling currencies in the future. In simple terms, traders bet on a currency's value against the dollar on a future date. For example, currently $1 is equal to about 83 rupees. In the derivatives market, traders can bet that the rupee's value could fall below that level, let's say 80 rupees per dollar, or rise above that level to say 85 per dollar at a future point. So based on expectations of the rupee's value at a certain time, businesses tend to offset any potential losses by betting or hedging against currency moves. The RBI's rule now states that anyone taking a certain bet in either direction will need to be able to prove they have forex exposure. So how will this work? Traders will now have to show dollar earnings or dollar payouts in their businesses to bet in the derivatives market as a hedge play. Currency derivatives often bring huge fluctuations in any currency's value. But coming May 3rd, trading in currency derivatives can only be used for hedging against price fluctuations and not speculative trading anymore. Moreover, participants needing to show their underlying forex exposure before trading will prevent random trades. How will this rule impact? The rule is likely to impact a majority of traders, with one estimate putting the figure at 80%. With many unlikely to be able to furnish proof of underlying forex exposure, this could bring down trading volumes dramatically. Some experts argue the latest rule could prove to be a costly step in protecting the rupee from fluctuation. Instead, the new rule could end up making India's currency derivatives unattractive for foreign investors. Still, some experts say the extreme moves in the rupee from the RBI's decision will only be temporary. Bureau Report, WION World is One.
And for more on this, we're now being joined by Amit Papare, founder and MD of Seya Forex live from Mumbai. Thank you so much for joining us on World Business Watch, sir.
Thank you for calling us.
I just want to begin by asking you, can you explain what the RBI's rule really means and its impact on the rupee and the country?
As far as hedging is concerned, and total volume of the position is concerned, you can hedge. The volume is divided into three segments. First is an currency derivative segment, and another segment is bank. In the bank, you will have two parts, which is merchant trade and interbank trades. So total volume, a derivative segment only constitute 10 to 14% of the total volume of Indian currency market. Now, as far as hedger is concerned, hedgers can hedge in bank also, and hedgers can hedge in currency derivative segment also. Now, we have close to 500 clients all across India, and out of that, 85 to 90% of hedgers prefer to hedge in bank. Only 10 to 15% of exporter or importer will prefer to hedge in currency derivative. Currency derivative was giving them an alternative platform to hedge with cost efficiency, and they can definitely hedge after 3:30 when the bank gets closed. So it was an alternative platform for them, but mainly they used to hedge in the bank. Now with RBI's new circular, it is going to tempt speculators and traders from entering into the market. And if you see all RBI circular, it is a clear-cut strategy from the RBI that RBI wants only hedgers to participate in currency, trading, currency activities. In 2020 also, RBI came up with a circular saying that if you want to hedge in the bank, there are only two provisions via which you can hedge. one is contracted exposure, and one is anticipated exposure. That also clearly signifies that RBI wants hedgers to be in the market. That is completely fine. But the only problem with the recent circular is that in the derivative segment, 70 to 80% volumes come from traders and speculators. They are providing debt and liquidity to the market. If that is withdrawn, then it is going to have an impact on hedgers also, because liquidity will reduce, debt will reduce, and the cost of hedging probably in exchange will also increase. So if I were to be a RBI, then I will try to find a middle solution where hedgers should be there allowed, which is currently allowed, but traders should also be given some amount of limit, say $5 million or $10 million, like that. So it will provide a balancing act where an hedger is also there, trader is also there, and currency derivative segment is also alive.
All right, sir. Now, that being said, what does the delay in the deadline for the rule to May 3rd from April 5th mean? And why do you think the RBI postponed the implementation of this time frame?
Yeah, there are, you can see that regulation coming yesterday night as two agenda. That is a positive aspect. First is that RBI did not wanted market participants to get panicked. That is why RBI have extended 1 month window. Second, in the circular, they said they are going to evaluate it again, how effectively hedgers and traders can work. So we can say that, RBI has given a listening voice to all the stakeholders, and probably in 1 month, we are expecting some kind of resolution by the regulator to come in and clarify further what they want market participants to do at current scenario.
All right. Well, sir, thank you so much for joining us on World Business Watch with your insights on this. For latest news, download the WION app and subscribe to our YouTube channel.